Welcome to the Kitchen Table Finance Podcast, where we make retirement planning easy and enjoyable. Discover practical advice to create a retirement strategy that fits your lifestyle and budget.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Well, it's warm inside, so I got that going for myself.
There you go. I've got my shades pulled. I don't need to see any more accumulation for the day. We're good.
Yeah,
We're
welcome
good.
to winter.
Yes.
We were questioning whether it would come or not, and it showed up with a vengeance. So
The
here
long
we are.
dark tea time of the soul. All right.
Well, today's episode is going to be a lot more upbeat than the weather, and that is because we are going to review the fourth quarter economic and kind of give a current market update here. So we do this once a quarter, just kind of going through and seeing what happened last quarter and talking about what that means for potentially the future. So
That's
with
right.
that, Dave, how did we do in the fourth quarter?
Well, the fourth quarter was pretty darn good. I think
Sure was.
the Wall Street Journal called it the everything rally in late December. Stocks were every subclass of stocks was positive. Every bond category in the U.S. was positive. It was quite the fourth quarter.
It's a good time to be a financial advisor. People think we look really smart in the fourth
Right,
quarter, even though we
right.
did absolutely nothing to
Absolutely
promote
nothing.
this.
The all cap, so like all company size index was up 12.1% for the quarter. And this capped off a very topsy-turvy but very, very positive year where the all cap index for the year was up 26%.
Yeah, crazy.
Yeah.
Especially when you consider like where we came from and what people thought was going to happen last year.
Right. You know, when we've talked a lot about that lately, but you know, the forecasts for 2023 were so gloomy, and it was really hard to be positive about anything last January. And that's just not how it played out. And it just underlines, and again, you know, we did a whole episode on forecasting a week ago, right?
Yep.
And you know, you just can't do it with any reliability.
Yeah, absolutely. Just
So yeah,
proof of what we've been saying the past couple of years as we try to predict things.
right. So the backdrop to all this good market return is that by all measures right now, instead of the recession that was expected, it looks like the Fed may have pulled off the soft landing scenario, which is where they were
Right.
able to raise interest rates drastically, bring inflation down drastically, and yet still we have strong economic numbers in terms of unemployment and
Yeah.
consumer spending, and you know,
I feel like it was the true underdog story of the Fed, right? Like they said
right.
they were going to do it, or at least try, but
Yeah.
nobody really believed them.
If I was Chairman Powell, I would have like at the last Fed meeting said, "Hey, here's all the data. Oh, and here's my resignation letter. I'm
Going
out."
out on top, baby.
That's right. That's right. Because we know as one of my favorite market psychology guys says, the phrase "this too shall pass." We use it a lot when the markets are down, but it also is important to remember when the economy and the markets are good.
Yeah, absolutely.
So
So one of the things we love to do on these market updates is just kind of give three positive signals and three reasons for concern. So what
yeah,
do we got going in the positive column,
yeah.
Dave?
So the first thing in the positive column was that it was a very strong year for investor returns, even with all of the noise. And you know, we've got this beautiful squiggly chart of what last year looked like in the markets with all the
Mm-hmm.
crazy headlines that were coming out that made everybody think we were just not going to make it.
Yeah.
You know, and all of this does is, as Mario points out, is just highlight how hard it is to time the markets.
Yeah, maybe I feel like we should run a test where we, have somebody read all of those headlines and then like
Yeah.
tell us what they think the market did.
Yeah. Yeah. Press
Maybe
press
in like
A for
3 years from
positive,
now when
B
people
for negative.
forget. Yeah.
Right. Right. Yeah, that would be informative, I think, enlightening for
Yeah.
the people doing it. So, and we hit on some of those numbers, in terms of stock returns, but you know, if we look at the numbers for 2023, there were zero recessions in 2023, despite everybody, all the talking heads on Wall Street saying we would have one.
Right.
Um, you know, uh, Inflation fell from 9% in the fall of 2022 to 3.1% by November of
Yeah.
2023.
Crazy.
And that's still higher than 2%, right? The Fed's target is
Right.
2%. So,
Hmm.
but definitely that trend better than expected and in the right direction. So, and that really is bullet point number two on the positive signals is inflation
Right.
measures continue to recede from those peaks, and that the
Hmm.
soft landing scenario does look real at this point.
Yeah. Yep. It's amazing that we have gotten that as our number two positive signal from where we were a year ago. So
uh,
we will take it.
yeah, yeah, yeah. And as we end up pointing out to clients sometimes, lower inflation doesn't mean deflation. We're not going down in price, but we're
Yeah.
not going up as fast.
That's right. Don't expect
So,
those steaks at your grocery store to go down. They might hold their
right,
value. They might
right,
hold at whatever it is a pound, but
right,
they're certainly not going to go
right.
down.
Right, right. So, and then the third positive signal out there, and I think we underestimate. We've talked about it a lot, but I think in general it's kind of hard to wrap people's minds around this, ourselves included,
Yeah.
is that one of the biggest outcomes of all this is now there is income and fixed income again,
Right.
and almost across the board, every one of our clients owns bonds,
Sure.
and for years, there was not a lot of upside in bonds except as a hedge against when things went really bad in the stock market. And now
Yeah.
those bond funds are starting to pay us just to hold them.
Hmm.
And that's important. That's important. And just getting back to a normal relationship between cash and bonds and stocks, that interest component of bonds is an important part of that. Now we have it again.
Yeah, super helpful, obviously, for especially for retirees, right? Like the
Hmm.
closer you get to retirement, usually you want to be a little bit more conservative, which means you're
Yeah.
holding more bonds. And now they're, instead of just being the, hey, this might not go down if the stock market goes down, it might go up slightly.
Right.
It will actually pay you, which is super beneficial when you're putting together those portfolios.
Right. Well, and we should add that why that that's a nice thing. That's a good thing. But also in terms of putting it on this list as a positive signal going forward, it means that there's upside in bonds.
Right.
They're not that holding bonds is going to be either way a positive component to portfolios.
Yeah. Yep.
So so yeah.
It's and we can kind of get into this a little bit at least, but it's one of those things where that income is there and it's not, just like inflation and
Hmm.
prices going down. The talk from the Fed has been they're going to keep rates kind of where they are. So I don't, there's not going to be a quick return down to the,
Yeah.
1% interest rate that we had
Yeah.
for such a long time. So another thing to keep an eye on is as those interest rates stay higher, those income from fixed income should be more of a longer term than a short term blip, right?
Well, there's that, and then there's also like the policy implications of having interest rates in a more normal situation. We talk about interest rates as being the fuel of the economy, right?
Mm-hmm.
And if you
Yep.
think about it, when the Fed is at zero on their interest rates and bond funds aren't paying us anything and investments aren't paying anything, that's like having your gas pedal on the floor, right?
Right. Yeah.
And if you need to go faster for whatever reason, there's nothing you can do.
You're
You're
right.
all the way there. And so right now, so if the Fed needed to speed up the economy and the gas pedal's already on the floor, there's nothing they can do. All they can do is slow it down by raising interest rates.
Right.
Now it's like the gas pedal's kind of in the middle, and if things go poorly from here, if we do have recessionary indicators, they've got room to lower rates, and those bonds have upside when that happens because
Right.
lower rates are going to push bond prices up in
Hmm.
portfolios.
Right.
So we've got some slack there to work with now that we didn't
Hmm.
have before. So I appreciate that as far as what it means going forward. And I hope we don't get to a point where we're back to zero rates.
Yeah, absolutely.
Yeah.
So that is the positive side of things,
You
Dave. What's keeping Dave up at night? What are we concerned
can't
about?
can't have one without the other, right?
That's right.
So we've again over the course of the last year talked about this one. It's still a potential issue in the markets, particularly the U.S. markets. Large company stocks have been driven by an exceedingly small number of
Hmm.
participants. We're
Yep.
calling them the Magnificent Seven now. It used to, we used to call them the FANG stocks, and as
Right.
it rotates a little bit, but Apple in 2023 was up 48.9%,
Wow.
Microsoft 58%,
Hmm.
Alphabet, Google 58.3%, Amazon 80.9%. Now get ready for this one. Nvidia, the chip maker,
Yeah.
driven by AI hopes, 239%
Crazy.
in 2023.
Yeah.
You know, Meta, 194%. Tesla,
Wow.
101%. Your money doubled in Tesla stock last year.
Crazy.
Um, Meanwhile, the S&P 500 had a fantastic year that looks silly in comparison to those,
Right.
26.3%.
Yeah.
Okay. So, the average stock in the S&P 500 didn't do a heck of a lot last year while these seven companies drove the markets. So
Mhm.
what's the problem there? A rally based on a really narrow handful of companies and very slim, all pretty much playing in the same industry is potentially fragile, right?
Right. For sure.
So to really feel good about it, we want to see a broad rally where all of the stocks are up a little bit instead of a few stocks up huge. Um, Mario gave us this slide that kind of puts things in perspective. If you took the market cap, so all the shares of Apple times its price plus all the shares of Microsoft times its price, et cetera, et cetera, et cetera, they total the economies of Japan, Canada, and UK combined. Those seven stocks. So
Crazy.
or I'm sorry, their markets.
Right.
So the entire all the Japanese stocks on their markets combined
Right.
total about half of Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla.
Crazy.
Yeah, yeah. So that kind of puts it in perspective. There's some things to think about here, though, too. There's some interesting statistics that look back at what's driven the markets over time. And
Hmm.
if you look at those statistics, this kind of market isn't that unusual. The number of stocks that drive returns over time is exceedingly small,
Sure.
surprisingly small. Like
Hmm.
basically something like a quarter of the stocks in the market historically have provided almost 100% of the positive return.
Yeah.
So the idea that a few stocks do really, really well while the most of them don't is not all that unusual. It's just a
Right.
little bit magnified right now.
Yeah.
So, so I wouldn't say that's keeping me up at night at the moment, but it's out there.
I think it's just one of those, like, when you think of it in terms of risk, like anything
Yeah,
that can go up 200% in a year can also,
go back
if
down.
it can go back down at a
Yeah,
staggering fast pace as well, right? Like what can
right.
go up can also come down. And so that's the
Well,
risk of having only seven of those companies. If they all start trending the other direction,
right,
that can do
right.
the opposite effect of what propelled last year's returns would
So
propel next year's losses, right?
yeah. So when you think about something scary like that, though, it's good to think about again, we want to be balanced. So what's the other possible outcome? If the soft landing scenario plays out, we don't have a serious recession. We have a slowdown. Things are slowing down. Um, but not a recession. You know, another potential outcome of this is we see those seven stocks kind of run in place for a little while the rest of the market perks up.
Right. Absolutely.
And so we can get to the point where this is a healthy rally.
Yeah.
This doesn't necessarily mean a bad outcome. It's just something to be concerned about as a potential problem.
Yep. Well, like you said, it could go either way, right? Like,
Yeah.
we just don't know.
Yep. Well, in
What
this,
else are we
well,
concerned about?
the next one I think falls into what we would call the category of there's always something, right?
Yeah.
Um, we've seen a lot of geopolitical risk over the last 12 months.
Yeah.
There was the Ukraine conflict's been ongoing for a little while. We saw increased intensity in the Middle East. As
Mm-hmm.
we finished out 2023, um, there's always, and the thing that's going to get you is going to be the thing you didn't think about.
Right.
So, but there's always potential that those issues are going to widen and become bigger conflicts. And the
Yeah.
bigger they become, the more distorting they become for the economy.
Yeah.
So, so there's that, and then there's good old American politics. We're listening to debates about government shutdowns, and how are we going to
Yeah.
just keep paying our bills, and and then you can't escape the fact that we've got a fairly attention grabbing anyway election coming up this fall.
Indeed, the calm before the storm in terms of U.S.
Yeah,
politics coming up, right?
it's kind of
Just getting started, folks.
based on the last 10 days, I'd call it the storm before the storm. But
Yeah.
one of my one of my favorite fictional characters would say it's always dark before it gets darker. Um, but
Indeed.
but yeah, so we'll be talking about American politics and presidential elections and the effects those can have on the economy. Spoiler alert: it's pretty unpredictable and not nearly as cut and dry or as fantastic as people are going to assume it's going to be.
Yeah.
But yeah, that'll be
Indeed. I
fun.
look forward to that. Our every 4 year political discussion about presidential elections.
Yeah, yeah, yeah. I'm just gonna pull out all the old stuff,
Uh,
dust it off, change the dates. Um, so,
yeah.
and then, like the third thing to focus on, it's still possible that inflation can increase. We've
Yeah.
seen this nice steady downtick, but the economy is
Hmm.
a fickle beast, and we could see a return to inflation. And like these last 2 points could be related. If we see continued unrest in the Middle East, that's going to impact oil prices. Oil prices impact inflation in the United States.
Yeah. Absolutely.
So, um,
We, just saw a little bit of an uptick in inflation this
mhm,
last reading that came out not too
yeah,
long ago.
it seemed like it was pretty much baked into the expectations going into the end
Yeah.
of the year. We saw would we come back at 3.4, I think, for December compared to
It was up a
3.1 in
tick.
November.
Yeah. Not much
Yeah,
at all.
but it didn't really register, and so I think it was kind of baked into seasonal expectations in a way. But um, yeah, it's always possible. And if we do see inflation tick back up, we're going to see the Fed have to either prolong where they're at in interest rates or raise them further, while the market has kind of built this expectation around interest rates coming back down a bit.
Yeah. So
Market,
that the great standoff between the Fed and the
yeah,
market, right?
yeah,
The
yeah,
market definitely is expecting some rate cuts this year, and the Fed is coming out and saying, "Not so fast, my friend."
yeah. So
We will see.
so that's kind of where we sit right now, and it feels a lot different than last year. I wouldn't say brimming with optimism, but at least we're not coming out of a deep hole where it just seems like it's going to get deeper.
Yeah, I mean, definitely going back to last year, and a better place, a better feeling than what we had in January of last year. I'd be interested to go and listen to our tone of voice on last year's quarterly
Yeah,
input.
yeah,
But
yeah,
and it just goes to show you never know, right? Like, and
right,
that's why we
right,
don't build portfolios for what's going to
yeah,
happen in the short term. We're building portfolios for what's going to
yeah.
happen in the long term.
We
And
we do this quarterly, because to not do it would seem like we were asleep at the switch. But really, you don't want to think about your investments in 3-month chunks. You want to think about
Right.
them in 10-year chunks if you can.
Yep. And
So,
just goes back to some of the other recent podcasts about the news and the media and all that stuff. That's
mhm,
just kind of noise of, they want to sensationalize all this. That's why there's so many headlines on
right,
that slide that Mario put together. And the reality is none of them really made a difference at all last year. And usually that's the
right,
case more often than not, right?
absolutely.
So, all right, Dave. Well, I look forward to 2024 and what the
Yeah.
future has to hold. And if our listeners are interested, if you haven't checked out our prediction podcast, be sure to check that one out as well.
Yeah.
So we are live and on the record of what we think is going to happen. So we shall see. So far, so good. We got 12 months to
Yep.
be right.
The future will be surprising.
There you go.
How's that?
I love it. I
All
love it.
right. All
All right.
right.
Thanks, Dave. Been a
Well,
pleasure as
take care.
always.
Yep. Thanks.
This is a Zedia Media production.